Hello. We would like to present our proposal with our portfolio strategy to shift to net zero position by 2032. Firstly, I would like to introduce our team, which consists of Prat, Tanmay, Sushil, and myself, Raghav. Now, I would like to take you through the agenda for a presentation, which includes a look at our current portfolio, a look at the problem statement, and we delve deeper into our approach in how to build a net zero portfolio, which focuses on global and Canadian equities, clean energy ETFs, and also green bonds. Then we look at the deconstruction of the portfolio returns and the impact measurement. Shifting to net zero is an important challenge faced by investors today. And as evident from the current portfolio of Canadian University, it includes financial instruments that are not particularly focused towards net zero or reducing GHG emissions. We have integrated different financial instruments in our portfolio in a manner that is oriented towards capital protection, has a low risk tolerance, seeks moderate growth, and has a long-term horizon. Moving on, we have integrated the different financial instruments in our portfolio, and the drivers for our investment strategy are increased consumer demand for sustainable and green investment options, policy and regulatory interventions at a return of 8% in line with peer funds. The problem statement that we face is how to achieve net zero GHG emissions while maintaining moderate growth. Our strategy uses equity, green bonds, and clean energy ETFs to substantially shift to net zero position by 2025 and a complete transition by 2032. The key success factors that drive our fund are diversification across asset classes and geographies, a return that adequately protects from inflationary trends, and most significantly, ensures a transition to a net zero position through access to reliable emissions data and subjective net emissions impact measurement. I will now pass it over to Tanmay.
So now I will discuss the approach for building this net zero portfolio. Moving on. So we followed a 5-phased approach to do this. In the first phase, we identified different asset classes. So for example, we reviewed fixed income securities, equities, real estate, infrastructure projects, and we reviewed their risks and return profiles to shortlist some asset classes. We also considered the impact of the investment in these securities on GHG reduction to come up with equities and ETFs and fixed income securities. After identifying these asset classes, we shortlisted securities within each asset class. So for equity, we identified companies which have net zero targets. For bonds, we considered companies which had high credit ratings. And for clean energy ETFs, we considered ETFs which have lower betas and very high geographic diversification. Now, next, we estimated returns for each of these asset classes. So for stocks, we considered beta as a measure of risk. So stocks which had higher beta had lower allocation. Similarly, for ETFs, we again considered beta as a measure of risk. And for bonds, we considered credit ratings because we wanted to keep credit risk under control. And bonds with higher credit ratings had lower asset allocation. Once we estimated returns for each of these asset classes, then we calculated return for the overall portfolio. That was based on identifying asset allocation for each of these asset classes. And then we also estimate overall portfolio risk to see whether we are still in the low risk space or we have crossed the moderate risk space. After constructing the portfolio, then we measured the impact of GHG reduction. So we used the metric of weighted average carbon intensity, calculating this metric for each of these asset classes. And then we set the target for the year 2025 and 2032. And then we kind of rebalance our portfolio to see whether we are meeting those targets or not. Moving on. So delving deeper into how did we come up with the stocks. So we saw various stocks in European markets, Asian markets, and North American markets. And we shortlisted companies which have already declared that they want to be net zero by 2030. Then we estimated beta for all of them, and based on their betas, we allocated stock weightages to the individual securities. Moving on. For bonds, we considered roughly 4,500 bonds, and these bonds again were for different geographies and had a lot of different sectoral exposure and varying credit ratings. To ensure that the credit risk remains in check, we considered credit rating as a major metric. So in all the investment grade bonds were shortlisted, and we identified 724 investment grade bonds as per Moody's ratings. Once we did that, we used carbon intensity to see where $1 invested can result in higher GHG reduction impact. Then considering geographic diversification, because we wanted to have equal number of bonds in different geographic areas, and also some sectoral diversification in financials, banks, public sector units, we've shortlisted 42 green bonds for our portfolio. Moving on. Now we'll ask Shushil to tell us how we estimated return for each of the asset classes.
Thank you, Tanmay. Let's now have a look at the risk and return profile of the various asset types that we have in our portfolio. So Canadian equities and global equities are the first asset class. We have applied the screening criteria. It consists of corporates that have committed at a policy level to reduce their scope 1 and 2 emissions to net zero, while also influencing their suppliers to reduce their own GHG emissions. The investment in the assets has been kept in accordance with the riskiness of those assets, with riskier securities getting less weightage. The result is interesting. Canadian equities give a less absolute return, but better risk-adjusted returns. The Canadian securities are much safer compared to global equities, as an equal investment in global equities creates a higher decrease in GHG emission compared to Canadian securities. As we can see here, the return has been substantially higher for global equities, but it comes at a higher risk level. Moving on to the next asset class. This sub-portfolio of fixed income is low risk and provides a low but steady return. We have specifically chosen green bonds that have little to no investment in GHG emitting projects. The investment in these instruments is in investment grade and weighed heavily towards less riskier ones. The additional advantage associated with this sub-portfolio is the diversification benefit in terms of asset type as well as sector and geographical diversification. This is because the credit market is larger and more widespread than the equity market. The GHG emission intensity of this sub-portfolio is around 30% lower than typical low-carbon ETFs, such as the iShare Global Clean Energy ETF. In addition to these, we also have a sub-portfolio consisting of ETFs that have very low GHG emission funds. The funds help to reduce GHG emissions faster and achieve the emission reduction targets set under our mandate. The return for this sub-portfolio is impressive at around 13% and helps preserve returns while other instruments are focused on managing risks. Moving on, let's have a look at the overall return and transition of the portfolio in the next 10 years. The portfolio, according to our estimates, will maintain a steady return of about 7% throughout the next 10 years. The final form of the portfolio will have about 37.5% green bonds, 50% equities, and 12.5% clean equity ETFs. Moving on, we can have a look at the transition of the portfolio. The portfolio transition is gradual, keeping in mind the fact that liquidating bigger positions can attract higher penalties and drive down prices, leading to losses. The liquidation from the old portfolio is gradual, and it's gradually invested in safer bonds and less risky choices from our equity and ETF universe. As we can see that the return is consistent and and spread with CPI in Canada is also consistently maintained in the long run at about 5%. Now, Pratt will take us through our impact estimation approach and results. Over to you, Pratt.
Thank you, Shishu. So from an impact measurement perspective, we consider two things. One, we want to measure the returns as one of the impact, and the other side is in terms of GHG reductions as well. So we set a target year 2025. We are targeting to reduce our portfolio exposure by 40% and then net zero by 2032. So by calculating this annually, we will know if there's a gap. If there's a gap, then we can divest and pretty much rebalance the portfolio to reduce the gap, either minimize it or pretty much totally eliminate it as well. The graph on your right, as you can see, the red line is pretty much the target we are trying to achieve. And then the models do indicate that our portfolio we are suggesting is going to be below our target levels from a GHG perspective. So that is how we're going to try to measure the impact measurement itself. From our company perspective, we are a client-centric investment management firm, which means that we can adapt to new realities way faster than the bigger player in the market, just because of our teams are concentrated, not centrally, we are decentralized globally. And that also helps us with gathering insights from research and analysis from the global perspective as well. And obviously, we will collaborate with all the bigger fund managers to make sure these firms are actually doing what they are saying, what they were set to do in their ESG mandates. And obviously, we are also signatory commitments to UN, PRI, and TCFD, and then GRESP as well. So because of our commitment, we are committed to the ESG-centric portfolio management. With that, we hope to do business with you in the future. And until then, see you later. Cheers.